Why were dot-com companies overvalued without clear profits? Imagine a time when everyone believed the internet would change everything overnight. During the late 1990s and early 2000s, that belief fueled a huge rush to invest in online companies. Many of these companies had no real profits or solid business plans, yet their stock prices soared. So, why did investors value these companies so highly despite their lack of profits? Let's look at what caused this bubble to grow so big and burst so suddenly. First, the excitement about the internet's future was contagious. People thought that online businesses would grow endlessly and dominate markets. This made investors eager to buy shares, hoping they would become very wealthy if these companies succeeded. Because of this optimism, many investors focused on what might happen in the future rather than what was happening now. Second, venture capitalists were eager to fund any startup with a .com address. They poured billions of dollars into these companies, even if they had no clear plan to make money. This flood of money helped many internet companies go public with initial public offerings, even if they had little or no revenue. Investors bought their stock because they believed in the potential, not the current earnings. Third, traditional ways of valuing companies were ignored. Usually, investors look at profits, cash flow, and how sustainable a business is. During this time, the market paid little attention to these factors. Instead, it focused on how fast a company was growing and how many users it was gaining. Many of these companies were losing money but still had sky-high valuations because they were expanding quickly. Fourth, the lack of strict rules and oversight made things worse. Some companies exaggerated their financial reports or engaged in questionable practices. Financial analysts and media often hyped these stocks, encouraging more people to buy in. This created a sense that these stocks could only go up, pushing prices even higher. Fifth, the overall economy was doing well. The late 1990s saw low interest rates, low inflation, and steady economic growth. Borrowing money was cheap, so investors felt confident taking risks. The Federal Reserve had kept interest rates low after a hedge fund crisis in 1998, which made it easier to invest in tech stocks. Finally, many .com companies believed the internet would let them skip traditional ways of selling products. They thought they could reach customers directly online and beat established competitors. But when these competitors also moved online and adapted, many startups struggled to stay relevant. This caused their stock prices to fall sharply and contributed to the collapse of the bubble. In the end, the overvaluation of .com companies happened because of a mix of wild optimism, easy money, ignoring traditional rules, weak oversight, and a strong economy. Investors got caught up in the hype, valuing companies based on what they hoped they would become, not what they actually were. When reality caught up with expectations, the bubble burst, and many internet companies saw their stock prices plummet. This episode teaches us how dangerous it can be when market prices detach from real business performance.